Let's start with a fair fight. Derek and Ryan. Same age, 32. Same income, $82,000 a year. Same tax bracket. Same starting point. The only difference? What they do with their money. Derek goes all in on dividend stocks and high-yield ETFs. He tracks yields, reads reports, and watches cash land in his account every single quarter. Average yield, 4.3%. He reinvests every dollar. To him, it feels like building a money machine, one that pays him just to exist. Ryan does something that sounds almost embarrassingly simple. He buys VOO, Vanguard's S&P 500 index fund, sets up Auto Invest, and never looks back. No research, no yield chasing, just the market, working quietly in the background. 5 years pass. Derek's portfolio is generating $3,100 a year in dividends. Real cash. His social feed is full of people calling him a genius. Ryan's account shows $79,000, and he hasn't received a single dollar in cash. By every surface-level measure, Derek is winning. But here's where the story gets uncomfortable. The illusion of income. There's a principle in finance called dividend irrelevance theory, and it's been established for over 6 decades. Here's how it works. When a company pays you a $3 dividend on a $110 stock, its share price drops to $107 the very next morning. You didn't gain $3. You moved $3 from the value of your investment into your checking account. Left pocket, right pocket. Same total. A dividend isn't a bonus. It's a forced partial sale of your own asset, just with extra steps. That alone might not seem like a deal breaker, but it's just the beginning. The tax drag nobody talks about. Every single time Derek gets a dividend check, even if he immediately reinvests it, the IRS shows up for its share. Qualified dividends, taxed at roughly 15%. Non-qualified dividends from REITs or certain funds, that rate can jump all the way to 37%. Year after year, before Derek's money even has a chance to compound, a piece of it disappears. It sounds minor at first. It's just a small tax hit. But over 30 years of compounding, even a 0.6% to 1.2% annual tax drag doesn't cost you $40,000. It doesn't cost you $60,000. It costs you $340,000. That number isn't dramatic. It's math, the hidden traps in dividend portfolios. There's another risk that rarely makes the highlight reel. Dividend cuts. AT&T, General Electric, 2 companies that were once considered bedrock dividend payers, both slashed their payouts dramatically. And when a dividend gets cut, the stock price usually collapses at the same time. You lose the income and the capital. That's a double hit most investors never fully recover from. Beyond individual stocks, dividend-heavy portfolios tend to cluster in slow-growth sectors, utilities, banks, telecoms. Stable, yes, but they've largely missed the technology wave that drove the majority of market returns over the past 2 decades. Derek's strategy feels safe, but safe has a hidden cost. 30 years later, let's see the scoreboard. Both men are 62 and ready to retire. Here's where they stand. Ryan's index fund, approximately $1,920,000. Derek's dividend portfolio, approximately $1,530,000. That's a $390,000 gap. And Derek never even noticed it shrinking, because his statements always looked green and his quarterly checks always arrived on time. Now, look at the taxes paid over those 30 years. Derek paid roughly $52,000 in federal taxes on his dividends. Ryan paid about $4,200. That's a $47,800 difference that went straight to the IRS instead of compounding in Derek's favor. But Derek doesn't have to sell anything in retirement. This is the argument dividend investors always return to, and it deserves a real answer. Both men need $54,000 a year to live in retirement. Derek collects $61,000 in dividends. After taxes, he clears roughly $54,000. Clean, simple, no selling required. Ryan sells $54,000 worth of his index fund each year. But here's the part that changes everything. Under current U.S. tax law, long-term capital gains can be taxed at 0% up to a certain income threshold. By managing his withdrawals carefully, Ryan can keep his annual tax bill near zero. Same lifestyle, same spending, but Ryan still has a portfolio sitting $390,000 higher. And it's still growing. So, should you ditch dividends? Completely? Not necessarily. If you enjoy dividend investing, put those holdings inside a Roth IRA or 401k. Accounts where dividends are sheltered from taxes entirely. In that context, the strategy has real merit. But during the accumulation phase, in a regular taxable brokerage account, the math is clear. Index funds win, lower fees, broader diversification, zero forced tax events, and full control over when you recognize income. The goal was never passive income. The goal was always maximum wealth, and those two things are not the same.